morning, everyone, and welcome to our session this morning on life insurance client needs analysis. Today, we're going to talk about helping the agent and the client be on the same page as far as what the client needs. There's so many examples around how this impacts the client and how we can help the client. So that'll be what we're going to talk about today in establishing the needs. First, let me introduce myself. My name's Art Crichton with InTouch Financial Group, and I'll host today's call to go over within 20 minutes, half hour at the most, about our client needs analysis and how we can work with our clients to understand what they need, or help understand how we can help them best. A lot of times we don't want to be order takers as agents. A lot of times the client will say, oh, I need $100,000 or $200,000. Where'd you come up with these numbers? Well, that's what someone told me, or that's what we need. So, it's great to do that. That's a great starting point, but it's always good to talk to the customer exactly what we need and how we're going to go about doing that. So we want to establish the need for the client, and we can do that by talking to them about the what's in a need, what's the needs analysis. So why do we do this? And we do it for several reasons. One, get my page up here. One is we want it to be interactive. We don't want to tell the customer what they need. We want them to really tell us what their needs are. A lot of times the example is, oh, I just took out a mortgage. I want a life insurance policy to pay off the mortgage. Well, that's great. That's a great starting point, but there's more to it than that. If we're going to do this, we want to do it right for you. So we want the client to participate. We want the client to talk. We don't want to be there just, okay, you want a $100,000 policy, here's a $100,000 policy, and have a nice day. The participation, make it interactive, have that conversation versus just taking an order. Second, buying versus selling. When the customer buys, it's a lot better than me selling them the policy. So we want to do an analysis. We just don't want to present, oh, here's that $100,000 policy, and that's it. We want to analyze what's their needs, how can we best help them. So they're going to make a buying decision, and we want to move that buying decision along to make sure that the customer has the right policy, the right product, with the right company, and they're going to walk out very happy, and they're going to refer us their family and friends to help them. Determine a more exact need. Like I said before, a $100,000 policy, that's great, but there's more to it than that. So we try to determine what the exact need, help the client determine what the exact need, not just an amount. What are we going to do for that customer? It's very much a client-centered conversation. For example, it's the client and the agent talking to one another. It's about the client. What does the client need? What does the client want? What do they want this policy to do? And that's very much that client-centered conversation. It's more, this is what you want to cover? Great. Here's how we can help you. Most likely increases the average policy. You'll see that probably 9 times out of 10. The customer comes in for one thing, you do a needs analysis, and it's probably going to be sometimes double, could be triple, but it's usually more they'll find in the client's needs. And lastly, avoid the common rule. I hear this all the time. What does my client need? Well, they should have 7 to 10 times their annual income. You know what? That's a great starting point, but it's not always the case. Maybe they have two children or 5 children. Maybe they have a $500,000 mortgage. Maybe they rent. 7 to 10 times you'll hear that or see that on websites where 7 to 10 times the income is the rule that you should have. Well, maybe they're older. Maybe they don't need the 7 to 10 times. Maybe they need 5. Maybe they got a lot of kids and college education. Maybe they need 15 times. So that common rule doesn't always work. Sometimes it's a good starting point, but it doesn't always work, and it doesn't really get down to that client-centered conversation. So with that, we just want to do a couple of, well, we'll move along the page here. So what's included in the client's needs? We're always going to start with the debts. How much does the client owe? Student loans, credit cards, auto loans. That's usually a good starting point. Most of the time, the client will know that. They can give you really round numbers. I have X number of student loans. We have about 5,000 credit cards. We have 1 or 2 auto loans. This is how much we owe, and we get an approximate. Income, this could be a little tricky, monthly or annually. Some people know their monthly income, some people know their weekly, some people know it annually. So we have to figure out what we want to use as the baseline. I prefer annual. Also, you'll see a lot of times here people say, well, it should be your net income after tax. Rightfully so, but you got to remember, this is a point in time that they're going to know their income today, and they're going to hopefully have more income increase as time goes on over the years. So I prefer using the gross, because that way we can account for a little bit more that's going to be in the future as their income grows. That's up to you, the client. You can use a net income, but I prefer the gross. It's a much more easily known figure. I make $3,000 a month, I make $50,000 a year, or $100,000 a year, whatever the amount is that the customer wants to use. The gross, and then when you get into net, it's taxes, it's insurance, it's health insurance, it's savings plans, it's all kinds of 401k contributions. It really gets a little bit more complicated, whereas you keep that gross number, it really makes it a little bit easier, and the conversation flows a little better. Also, how long do I want to replace the income? A common measure is when the youngest child leaves home, graduates high school, starts college or their own business, or gets out into the working world. This is a very fluid number. If you have a 5-year-old, maybe you need 13 years, you want to round it up or down. It's a number that can be very flexible. Mortgage, how much do I have to pay off my mortgage or significantly pay down? Some people have large mortgages, may just want to pay down the mortgage. But again, this is up to the client. I usually prefer payoff. How much do you owe on your mortgage approximately? People can look that up very easily, or they know I owe about $200,000 on my mortgage. Great, let's use that number. Education is an optional number. How much do I need to send my son or daughter or children to college? It may even include private schools, special needs schools, which may be longer in length. So education can be very difficult. What if my child doesn't go to college? Then what happens? So there you may need some money to let them start their own business, or let them just a nest egg to get started. Which is always good as they're leaving home and getting into the working world or a vocation, things of that sort. So education, while it's optional, if the desire is for the parent to send their sons or daughters to college, this could be a really big number. It can be a small number. We're doing some college shopping now for my son. I've seen anywhere from tuition at $10,000 all the way to $75,000. You add in room and board, you add in fees, expenses, it can really get up there. So sometimes you have to do some really good approximations. Final expenses, this is pretty standard. I've seen anywhere from $10,000 to $15,000 for funeral and other expenses. This could be a little higher if you got some medical expenses at the end of life. But if you just want to cover final expenses, a $10,000 or $15,000 amount is usually fairly standard. Okay, so let's get into, I did 2 examples here. The first is the sample family who comes to you as the agent with a request to cover their mortgage. They owe $250,000 on their mortgage, and they say, great, I want $250,000 if I die. My husband, who stays at home with the child, won't have a mortgage to pay. Great, okay, let's have a discussion. So we know that Terry is working. She's an RN. She makes $70,000 a year approximately. And Chris is a stay-at-home dad, 32 years old. They have a 10-year-old child, and they have some savings and an existing insurance policy through work. So this is a very standard household. And so let's do some analysis for the customer. So we want to pay off their debt. They have about $55,000 in debt. The income we want to replace here, we have a 10-year-old child. They desire the child to go to college, hopefully. So that's going to be in about 8 years. So they want to cover the next 8 years. So if something should happen, there would be enough income. If something happened to Terry, there'd be enough income for Chris for the next 8 years to get them through the middle school, elementary, middle school, high school years. Their desire to pay off their $250,000 mortgage, and then we just want to pick an education. Let's say they want to go to a state school. It's a little bit reasonable. In Georgia, we have the Hope Scholarship. So maybe they want to take $50,000 for insurance. They got about $10,000 in final expenses. If something should happen to Terry, you add that up, you reduce it by how much they have in their savings, about $75,000. So Chris would get that if Terry were to pass away. And Terry also has $100,000 through work. So if you add that up, and subtract out their savings and their existing life insurance, it comes out to about $750,000 for Terry. So here you can see, so what are we doing for Terry and Chris, the sample family? $750,000, what's that going to cover? It's going to cover about 8 years worth of income. It's going to pay off all their existing debts. They're going to have a free and clear house. They can put $50,000, maybe even more, $1,000 and $50,000 for education, and have money to pay the final expenses. And then there's life insurance and some savings that they already have. So you have a $750,000 policy. That's actually 3 times what they initially requested. So you can see from the previous slide where we said that it comes out to a lot more. It does. It comes out to a lot more in a case like this, because we're doing more than just paying off their mortgage. It's great that they would have a free and clear house, but think about it. If Terry were to pass away, Chris would have to go back in the workforce. I don't know Chris's previous education or experiences, but if he's been home with the child, he may not have easily to be a high-paying job. He'd also have to consider childcare expenses for a few years till the child gets a little bit older. So this is a good example for Terry. $750,000 could be a starting point. It could be higher, lower. We can get into how much they could afford and things of that. But it's a really great way to get into that conversation with the customer, with the client, show the client how much is needed, and then you can work from there. Okay. Let's go to the Rose family. They're interested in $100,000 to cover their 15-year-old who's going to be in college soon. Mary's a 40-year-old teacher, makes about $45,000. John is a 45-year-old construction worker, making a little bit more at $55,000. Again, they have some savings and some existing life insurance. So the key question here is, who should be insured? Since they both make pretty about the same amount of money, my answer would be both. And more than just $100,000, as we'll see in a second here, there's a lot of need here. So if we go to the right-hand side, how much insurance would be needed? They got about $30,000 in loans. We're going to say about 5 years worth of income. Because you got a 15-year-old, 3 years maybe not enough. So we're just going to take a round number and say 5 years. And I did $50,000, which is just right in the middle between Mary and John. They have a $125,000 mortgage. They figure their education expense is $100,000. Maybe the child wants to go to a special university. Maybe it's out of state. Maybe it's going to be more money or whatever reason. That's what they figure. Again, final expenses are about $100,000. They have about $190,000 in savings and life insurance. So the need comes out to about $325,000, and that could be for each. So this is really gets down to the customer. How much do we need? We can go higher, we can go lower. If they want to do one person now, one person later. I would probably prefer to do both of them at a lower amount if there's a price issue here. and then maybe they can pick it up a little bit later on. But the key here is, since they both make about the same amount of money, that they should each have a policy to cover one another. So if John dies, Mary has money for the mortgage, for educational expense, and to pick up some of the income that would be lost. So two really good examples, and how we can work with the customer, work with the client to make sure that they're walking out with a little bit more than this, in this case, the educational expense. That's great, but if there's a death, it's going to be really hard for them to live on just one income with their existing debts, education expense coming up. So it's really something that we want to help the client with. So what are the next steps? Just the policy amount is needed. In the prior example, you see it says $325,000 each. You start doing the premiums for them. It could be a little bit more than they could afford, so maybe we want to adjust it down. Maybe they can afford it. Maybe we want to go a little bit higher. Maybe they want more than 5 years worth of income. So I always call it like a car sticker shock. Ooh, wow, I can't afford that car. But we need to make sure we match affordability with need. Explain what the policy will cover. This policy will replace your income, pay off your mortgage, provide for your child's education. Just like in the prior example, let me turn back here. So when we're talking to the customers, these policies would cover each of you. So if something happened to either one of you, you'd have 5 years of income replacement, your debts will be paid off, your mortgage will be paid off, you have enough money for education and for any final expenses. And then you can also use your existing savings and life insurance that you have. So what you want to do is you want to tell the customer exactly what they're buying and what it's going to do for them. They're going to walk out knowing, okay, if something happens to me, this is what my spouse is going to get, and this is what she can use the money for. Gain agreement to the policy amount. If in the first example, let me go back to the first example, $750,000, excuse me, $750,000 could be a little bit more than the customer could afford once we do the premium. So maybe we take that down a little bit. Maybe it's not 8 years, we do 3 years worth of income, or excuse me, 5 years worth of income. Or if we want to pay down the mortgage versus pay it off. So you can always use those numbers to adjust accordingly to what the customer can afford. Okay, and then obviously begin the quoting process. So we have the customer, we advise the customer what the money can be used for. We've gained agreement on what the policy amount is, and now we can begin quoting the policy. So what do we have here in summary is we have a customer, or two customers in this case, who wanted something very specific, but yet when we really dig deep and do the full client needs analysis, we learn exactly what the customer will need. Then we match it with what they can afford, and we come to an agreement, and then we can begin quoting the policy. And I think when you do this, you'll find that the customer is much more happier, because they're walking out with a policy, or they're applying for a policy that's going to provide not just for one reason, but for a variety of reasons for them to have this policy. Okay, so I hope you took something out of this to learn, because we got really good additional sessions coming up. We're going to talk about life insurance products. I did that 2 weeks ago. We did a real overview of term and whole life, and indexed universal life, and things of that sort. So we're going to get more into detail on those. We're going to talk about living benefits, quotes and applications, talk a little about carriers. COVID-19, I'm hearing a lot of things around how that's impacting the life insurance industry, field underwriting, and we got a variety of other topics that we're going to be coming out with to show everyone. If you're interested in an appointment, if you're not appointed with InTouch, please give me a call. We can send you the information to get an appointment. We'll also put a recording on our website, intouchfinancialgroup.com, so you can have access to this recording. If you have any questions, my phone number, email address, and we'll also send everyone a copy of the presentation, so you have that. And we also did a needs analysis form